Take it away, Jim.
Hey, thanks, Chris. I appreciate that. And hello, everyone, and welcome to our virtual home buying seminar, Heading Home presentation, the basics of purchasing a home. This is my first Zoom, so I'm looking forward to walking through this with everyone. Again, welcome, and thanks for joining us. So today, we are just going to touch on what it takes to think about what you need to know and prepare yourself for this adventure. So when buying a home, right, you're going to have a sense of community with the home that you purchase. You're becoming part of with your neighbors and everyone there. The home that you buy, you'll be able to customize it over time. You'll paint your walls the way you want to paint it. You'll add the furniture you want to add. There's no landlords because you're now the landlord. You will build equity in the home that you buy. And then, of course, there are tax deductions as relates to owning a home, but I always have to advise that you talk with your CPA or tax advisor as it relates to those tax deductions. And then you have the pride of ownership by having your own home. Along with that, with having it financed, you'll have a fixed rate mortgage payment stability. So whatever rate is locked in and the loan amount, you'll know that your principal and interest payment is fixed as it relates to your regular monthly payment. While renting, right, you can easily relocate typically as you need to move, or if you're changing jobs and have to move to a new area, you can pretty quickly probably be able to cancel your current rent or lease. You can work those things out with your landlord. You have market freedom because you can choose and move along where you need to pretty easily. You have a little more credit flexibility relating to renting. And there's less upfront costs. Typically, you have your first and last month's deposits or some type of a security deposit that you'll make. And then typically there's no maintenance responsibilities relating to some of those items. It can be different depending on your current rent or lease agreement with your landlord. So what about renting? So if you're renting, or say for example from this table that I'm presenting, assume that you're renting for $1,500 a month, and that there's a 5% increase per year to your rents. You'll find that your first year at $1,500 a month, your annual rent will be about $18,000. And as that progresses through the years, if it goes up 5% each year, by the fifth year, your rents could be just over $1,800 a month, or payments of almost $22,000 in annual rent that year. So when you add that up over 5 years with that 5% increase a year, beginning with the first $1,500 a month rents that you pay, towards the fifth year where it's just over $1,800, you will have paid about just over $99,000 in rents, almost $100,000 in rents for your current housing. By buying and purchasing a home, think about what you can be putting into your home. You're putting in your principal and interest into that. So those are the big keys of trying to make where homeownership is a positive for you. So what are some key questions as it relates to what you may be thinking about? How much of a payment can I afford? What type of dwelling am I looking for? How long do I want to be in a home that I'm at? The question of that being is it your forever home, or is it that in 10 years you're probably going to move somewhere else because of job advancement, or you have a first-time home that you're just starting off with you and your partner, and then your family grows, so you need more room, so you may have plans to grow your family. And so in 5 or 10 years, you may want to sell the home you're in now to buy or purchase a larger home. Of course, with growing your family, you may have children, and you want to consider what school system you want your family to be involved with. You'll be looking at new construction versus existing homes. So you might look at homes that are just been newly built compared to homes that have been existing for a while. Those are things that you'll be looking at. The biggest thing is for you, the person who's purchasing the home, is location, location, location. What are some financial items to consider? That would be your budget, your assets, and your credit history. In your budget, what is your current payment that you have? What is your comfort zone as it relates to a regular monthly payment you would be considering to making each month on a mortgage? Your assets, how much funds do you have available to you to place as a down payment and maybe be able to use as closing costs? What are those assets? Is it savings that you have, a 401k, or is there a retirement system with your employer that you have that you can draw some funds off of? Or even maybe gifts from family members. Credit history. Your credit history, compared from good to fair. Basically, with your credit history, your interest rates are a little bit better when you have a good credit history to excellent compared to being good to fair. So what do we do when you are considering buying a home? Well, one, you'll prepare. Two, you will apply. Three, of course, the loan will be processing. And four, it closes. So let's go over a few of these things right quick. Let's start with finding a loan officer, right? So in preparing, you're going to reach out to Mountain Credit Union, to one of our offices, and you're going to touch base with one of our lending specialists there who can talk with you a little bit about using credit, income, and asset information to help determine your eligibility and qualifying. You'll get pre-qualified. They'll talk with you about the differences as it relates to your income, your debts that you have outstanding that you'll talk with them about, and you can tell them a little bit about your credit score. So those are the things that will help our lenders in the offices talk with you and give you an indication about what it is that you may pre-qualify for as it relates to a purchase price and a loan amount. So the next step after that is typically to say, okay, you're ready to buy a house now after you sort of know a little bit of information from the loan officer about pre-qualifying. So you really want to take the next steps, and you really want to see that what you can really be approved for. So, or if you have a house in mind already and you're getting a contract signed, you'll need to talk with the loan officer about filling out a mortgage loan application. It's now there's an update in the applications now, and they're known as a uniform residential loan application. The loan officer will help walk you through what needs to be done to complete those. They'll help you and guide you to gather all the documents that we need that is necessary as it relates to income and asset documentation to help move the application along. And then, of course, we'll review our checklist to help you get started on what's needed. As you can probably see on your screen, you'll see that there's a list that we sort of have that walks us through when we're assisting our members and our clients. So typically, how would you pay for a mortgage? That's a source of information that you need. You need to obtain pay stubs, W-2s, etc. So as you can see from this list, it is a little introduction about what we need. Sometimes we may need more depending on the situation. As it relates, if you're self-employed, we would need to obtain 2 years of tax returns as it relates to your business and how that operates. Again, the lender will be able to help walk you through about what that documentation is and what we need and how it supports it. And of course, if you are purchasing a home and you've signed a contract, we need a copy of that purchase agreement, that offer to purchase, and needs to be signed by all parties, and that will help us really get moving down the road to home ownership. So some of the things I just sort of talked about, getting conditionally approved. So after you submit all that information, again, the loan officer will require, or build a file and create one that helps us move through that conditional approval process. And as you go through that, we are able to pre-qualify you, pre-approve you, we can present you a letter that can help with working with a local real estate agent that you may know. Because when they're looking at and trying to help you find a home, a lot of sellers or agents that they're working with, they want to know that you're able to qualify and that maybe you're pre-approved already and a good risk to move forward with and to talking with about purchasing the home you're looking at. All right, so you've gone through those first few steps. You've gotten that pre-qualification done. Now you found that place where you're looking to be pre-approved. Now the loan officer needs to obtain a lot of documentation, as we sort of talked about on that checklist. So if you'll follow what the loan officer is trying to do for you, providing all that documentation up front as soon as possible is big and key with helping getting through that approval process through our underwriters, because they're always checking and double checking the information that we're obtaining to be able to move forward for you. So we want to be able to verify and satisfy that information we know they will need ultimately to help us get that pre-approval, and for us to be able to even lock your interest rate when we're able to move forward with a property. So who does what during the home buying process? So when we get things started, there are third-party services that we have to use to order certain things. So we are, one, having to require an home appraisal. We will need to order that through our appraisal desk, and they'll order that from an appraiser. And then we're also needing to set up a closing date and time and order title insurance or a title request that verifies and helps us to know and understand that the property that you are purchasing have no other defects or liens. And also we're obtaining a credit report, and also we need to obtain homeowner's insurance, a quote, who will ultimately be underwriting your homeowner's insurance. So that's one of those things that you'll be choosing as it relates to who you want to use, and we'll have to order those things through those third parties to help us obtain that information. And then we've made it through all the process, and its loan is approved. So it goes to our closing area, and so it can be cleared to close. So after all the conditions have been reviewed and your file marked and said, hey, they've passed everything, property looks good, income looks good, the sources and the loan option that we have are good, you're cleared to close. So now our closing department is working with the attorney's office to finalize closing packages and get you to closing so you can get the keys to your new home. Those are the big things that we have to do. So our lender, the closer, is working with the attorney, preparing the closing documents and sending out all the necessary updated closing disclosures and schedules that you will need to know at closing. And you close your home. Yeah, and some of the little notes here, closing is typically held at the attorney's office or a title company. So that's one thing you need to make sure of, is having that time set aside as we get towards closer to that date that is sort of predetermined to work with a target date. And then when you go to closing again, don't forget to bring your identification with you. The closing will last typically somewhere around an hour. Can be a little less, can be a little more, just depending on timing of everything and how crazy it might be in getting some of the documents done at the closing time. So what are the basics? Well, some of the things that you may be asking, how much can I afford? Well, in determining that, we need to know your credit history. We need to know what the available funds for down payment may be and what the closing cost could be. We need to know your income. We need to know what your existing debt and financial obligations are. So we'll have some information from the credit history, from our credit report, plus what you tell us. We'll need to know and understand what your total assets are. And then also we need to know and understand your current employment history and resident history. Looking for typically employment for 2+ years and a current resident history of 2+ years. That could be, you could be on your current job maybe just 6 months, but you changed jobs from a prior job that you had for either 1 year or 2 years. So we're trying to verify a history of at least 2+ years as it relates to that. If you just graduated from college or you're just starting up a new job, typically you'll have some type of education or background as it relates to it, and we can work through those scenarios. Take a little sip of water. So checking your credit or understanding your credit score. Have you checked your credit score recently? Do you know what your score is? Something to think about, because that's what we as loan officers want to ask you to sort of see where you're at when we first talk with you about pre-qualifying. You can get a free copy of your credit report, of course, each year from each of the 3 credit bureaus. You can check your credit report for any mistakes or improvements you may need to make before applying for a mortgage. And encourage that lots of times, especially if there's some things on your credit report that are not correct, that you dispute. And knowing and understanding your credit is very important, because it can keep you from getting the best interest rate out there, and it can possibly, as it relates to some things, keep you from obtaining a mortgage loan, because the credit could be in a situation that doesn't work for you. So exercise your credit just like exercising for your heart. Use it a little bit, make sure it is in shape. Do the things you need to do to keep your credit in good shape. Now, how does your score compare? Basically, to the average millennial credit score is running about 625. So think about your credit score to the average millennial credit score that we reflect here. And then what is the average US credit score? So from a couple of years ago, it was running about 695. So what is your credit score? Is it a little higher? Is it a little less? So you know and understand how your score reflects to these averages. So the importance of credit, right? So lenders, insurers, service providers, and even employers use credit information, right, to gauge if they're dealing with someone who is reliable and responsive. Qualification, is a big dependent on credit scoring. Higher credit scores result in lower rates, potentially saving thousands of dollars over the life of a loan. The lower interest rates can translate into more home to purchase for the buyer. So how are Fico, Fair Isaac Corporation credit bureau scores calculated? Well, first, your payment history. The payment history consists of about 35% of your total score. This shows whether you've made your payments on time. Outstanding balances, that consists of 30% of your credit score. This shows how much you owe versus how much available credit you have. Age of your credit history, that's 15% of your score. The longer your accounts are open, the better. New credit lines and inquiries, that consist of 10% of your score. Going on a credit application spree in a short amount of time, right, can represent a risk in lowering your score, because all of a sudden you're going out trying to obtain a lot of credit in a short period of time. Not that it's bad, not that you misuse it, but it's a risk factor that pops up and shows as it relates to when lenders are looking at someone to qualify. Types of credit accounts and the diversity accounts about 10% of your score. Having a good mix of credit cards, auto loans, student loans, and mortgages is better than just having one type of loan. Because if you have just a car loan and you pay it off, well, guess what? You're not really exercising your credit, keeping it in shape. So having a few little items along with a mixture helps build your credit. So 3 major credit reporting agencies use the scoring systems. You can obtain a free credit report from each of the 3 major credit bureaus. And you can obtain a free credit report from the link that I show here. It's www.annualcreditreport.com. The repositories for credit are Equifax, TransUnion, and Experian. Some of you may be familiar with Equifax, TransUnion, or Experian. Experian has been advertising a lot lately and doing some things about trying to help you and show you what your current credit scores are. So let's go through an example here of a credit score rate comparison, just as an example. So we'll start off our example with if you had a 660 score or less, and you were trying to obtain a loan amount of $225,000. It's a 30-year term. The rate is running about 5% with the credit score of 660 or less. The payment on this 5% rate at 30 years for 225 is $1,207.85. And your total payments over 30 years would be $434,826. So when you compare that to a person with a credit score of 720 or better, we're doing the same loan amount, same term. However, the rate reflects a 3% rate, which indicates and shows a payment of like $949 a month, with a total payments over those 30 years being $341,500. So you can see the difference between the payment of the lower score to the higher score is about $259 lower with the higher score. So you can see that. And then over time, basically, if you were able to do the lower payment, saving that $259, you're going to save overall about $93,000 in the long run. So those are big things to consider as it relates to trying to, keep your score as best you can regarding your situation. Now, understandably, things do happen. Life does happen, and we have to deal with things that we have to deal with, which sometimes will hit our credit. Hey, it happens. That's why I know we have great counselors in our offices that can help you and walk you through some things that can help build your credit scores if your scores are on the lower end that can't help you to qualify at this time. So please remember, Mountain Credit Union does offer a great service with our lenders and our counselors, or counselors who go through a big education that can walk you through those things that can help build your credit. So why do you need a down payment? Right? A down payment shows lenders you're capable of saving money and that you're serious about an investment. How much money do you need to put down? Well, it depends on some of the situation. Down payment requirements vary from loan to loan. Conventional loans typically require a down payment anywhere between 5%, and 20%, depending on what you're looking at, what you're trying to do. So, an example, there's a $100,000 loan amount, a purchase price. 5% would be $5,000. Whereas government insured loans like VA, USDA, FHA, they offer lower down payment options, ranging from anywhere between no down payment for a USDA loan, even a VA loan, to having to make a 3.5% down payment on an FHA loan. Keep in mind, some down payments can be gifted depending on some of the loan programs as it relates to it and how it can be verified. So there are options out there to have gifted funds to help with down payment and even with closing costs. The different loan options, right? So it varies. Oh, I went too far. I need to try to go back one slide. Conforming loans, we can do conforming loans up to $548,000. And there's jumbo loans that are out there that could go over that amount. FHA mortgages require a 3.5% down payment. And the most on a FHA loan that we can do in our area is around $356,000. We have, of course, VA mortgages that have no down payment, and USDA mortgages that have no down payment. Remember, the different programs and different options sometimes require a little more stricter guidelines. Therefore, we have to probably walk through some more challenging paperwork, but it can be done. We walk you through it, we get through it, and it can help you get to homeownership. So, other costs to consider, right? You have your closing costs. In general, as noted here, you can expect to see between 2 to 6% of your purchase price in closing costs. And there, of course, are 5 types of closing costs that are out there that add up together: your title recording fees and transfer tax fees. You have prepaid and escrow options. These are the prepaid items are such as your homeowner's insurance, your taxes on the property, any prepaid interest that you may have. We'll dive into that a little bit more as you talk with your loan officer. And then, of course, mortgage insurance, depending on the loan amount you have and what the loan to value will be. You have other loan related fees such as an origination fee, you have application fees, underwriting fees, you have credit report fees, you have appraiser fees, and of course, again, like mentioned, attorney fees, survey fees if needed, and any home inspections that you may want to obtain. So one of the big things that we have to do in helping you know and understand if you can qualify for a loan is considering what is the debt to income ratio. This is something we have to go by as it relates to regulations and guidelines as it relates to the different loan programs. Your debt to income ratio is something that mortgage lenders look at very carefully when determining how much you can afford. Generally, right, the lower your debt payments and the higher your income is, of course, the more you can be approved for. In most cases, lenders will want your total debt to income ratio to be 43% or less of your total gross income. So what you would normally do is say, if you were just doing something at home, you would say, "Hey, I wonder what my ratios are." You could say, "Okay, here's my total gross income for my W-2s for 2020," and you write that down. Divide it by 12, that comes up with a monthly figure. Then you can take your regular debts that you have each month, not counting, anything like utilities or power. You're just going to take your debts relating to your credit card debt, your consumer loan debt, your auto debt out there, and take that, add it together plus whatever housing payment you think you'd like to do. Total that together and divide that by your total income. So do that as what are your monthly payments on your debt, and then divide that by your monthly gross income. That'll give you sort of an idea if you're trying to look at it. The right time to buy, right? Financial timing for all of us. How do we do that? So, when renting is no longer a cheap option, right? Rent prices often increase over time, but we've got to try to figure out where we get a home with a fixed rate mortgage, and where your monthly payment will stay basically the same, other than taxes and insurance that may change over you. It can be a cheaper way to do things now compared to doing things 5 years from now, as it relates to it. It's all in your personal timing as well. When you're ready to commit to a place that you want to move to, or an area that you want to live, when you've got stability, you know and understand your job stability and income is good, and when you feel comfortable in taking on the next steps, when you're ready to take on having that regular mortgage payment, taking care of your home instead of renting from someone else. So you now know and understand some things about how to approach your first home purchase. You now understand a little bit more, so each time you look at these things, you become a more educated consumer. These are the things that help you take the next steps to be involved in obtaining a home. So, Chris, I'm through with my part of the presentation here. I'll let you take the next steps here as it relates to the next portion and getting to the questions.
All right, thank you, Jim. We appreciate that. I know that we went through that pretty fast, so we could save some time for some questions, and a few of the questions have actually been answered in real time in the chat by Tanya and also by Kathleen. Kathleen, if you want to, would you introduce yourself real quick? Kathleen's a local real estate agent, and there was a question about how you go about finding a good real estate agent to work with. And one of the main reasons I would choose to work with a particular real estate agent would be just from word of mouth, or someone has worked with an agent that they work well with, and they can recommend or highly recommend them to use. And one of those in our area, at least in Asheville, is Kathleen. She's somebody that I trust to send referrals to, and then she trusts us to send her clients for their loans. So it's a good mutual relationship that we have. So I want to let Kathleen introduce herself real quick and just let you know who she is and what she does in the area.
Thanks, Chris. Hi, I'm Kathleen Cook. I'm with Mosaic Realty. We're located in downtown Asheville. Our full name is Mosaic Community Lifestyle Realty. I've been in the business for a number of years now. And I think referral business is a big thing. If you have a friend who's had a really good experience and they say, hey, I recommend working with so-and-so, that's the base of our business, because that way it's you're getting a good personal review from someone that you trust. And I also look at it too as it's a little bit like matchmaking. Everybody has a different kind of personality, a different communication style. And so you really want to be working with somebody who you resonate with and that you feel comfortable and confident in, because buying a home is a really big process. And our job as agents and what Chris and with Mountain Credit Union, all of us together, our job is to hopefully make this process as less stressful as it can be. So you want to pick somebody that you just really feel comfortable with. And you're really not in a situation until you sign you sign an exclusive buyer agency agreement. That's when you kind of, you're creating that commitment and having that relationship together with an agent. Prior to that, you can actually just call different people or ask questions. So there's a lot of different ways to go about it.
Perfect. Yeah, thank you for that answer. Let me look and see. There is a question, how long should you work with someone before signing that?
That depends. I mean, if you really feel comfortable with someone, every agent is different. They may actually, after you see a house together in person, they may want you to sign it, because we are running a business. So we want to be investing our time where it's well spent, and understanding we're moving forward together. Plus, as a buyer, you're going to be discussing information that is private. And so it's our fiduciary duty to keep that confidential. But once you have that buyer agency agreement signed, that's kind of a sealed deal. And it's where, it is our duty to keep everything confidential, and we're working solely for the buyer. So it can happen within, a couple of days. It can happen in a couple of weeks. It just depends on how quickly you're moving through the process.
All right, thank you. Any other questions? Type those in the chat. Oh, how many houses do agents expect to show before someone buys?
That again, that is actually, it's just kind of depending on the situation. We are in kind of a competitive market right now. So you could be looking at seeing, anywhere from, 2 to 3 homes to 25. It just depends. Agents, we're now doing, a lot of virtual tours, drive-by. So there's ways in which you can kind of get a sense of the property without being in person. We had adjusted over the past year due to COVID. But it really is situational. So it could be a long process, and it could be really quickly too. Sometimes, the market, things can come back on the market, and you're kind of like, hey, let's go see this house this afternoon. And if it's a good deal, we're writing up an offer and moving forward.
I kind of chuckled at that, because I bought a house 4 years ago and I felt like I was driving my real estate agent crazy. But the market was different then, like you say, and there were a few more houses available back then. Now it's like you almost have to, I don't want to say you have to buy the first house you see, but the market's a lot more competitive now than it was 4 years ago. So yeah, thank you for answering those questions. One last thing I want to point out is that, Jim mentioned our financial counselors. I got to give them one last plug. We have 15 financial counselors on staff at Mountain Credit Union that can help you make sure that your budget's in order and that your credit score is in line before you make a major purchase, especially with home buying. And we do work up pre-qualifications. I know that it's not a requirement, but a lot of real estate agents want you to have a pre-qualification letter before you go on any kind of showings with them. So that's something that we can get you set up with before you talk to an agent like Kathleen. Just, again, because it's a competitive market, you want to have all your ducks in a row. So if you need to start now to get your credit in order, sometimes those things take time. So we can work with you 3-6 months, however long it takes. Then you can take that letter to the agent, and that helps with the showing. Jim, can you talk a little bit about the difference real quick between a pre-approval and a pre-qualification?
Yes, Chris, thanks. Pre-qualification. Pre-qualification, basically you're talking with your loan officer. You're answering some questions from the loan officer about what is your income. They're trying to determine exactly what that is, so be as accurate with that income that they ask you about. Talk with, tell them, when they ask you about your debts, be sure to tell them the debt. So we're working through some things and saying, okay, now how does that compare? How much of a home or a purchase price that you're looking at? And then the loan officer will take the information relating to the conversation, going through these qualifying questions that are being asked as it relates to it, without pulling a credit report at this time or digging in real deep as it relates to it. So we're doing a a highlighted version basically up front to say, hey, the things you're telling me, of course, if we have to go further for an approval, we'll need to obtain these things in writing or documentation to show that they have that income they've told us, they have that savings or those assets that they've told us, and that we verify with the credit report they have the credit score that they have for us. So pre-qualifying is sort of like just an open conversation that we're talking with them about, and they're giving us the information. And typically, normally, especially here at Mountain Credit Union, we know who our members are, so we have a good history with them, right? So we feel really good about those timings and talking with them. They may not quite be ready for that house yet, so that pre-qualification letter is much easier to do up front compared to the pre-approval, where we have to get all that documentation and a completed mortgage loan application completed, and we have to verify those items to get through for a true pre-approval. I hope I answered that question as you asked with a short version of it in both comparisons, but those are the things that can be helpful as it relates to a realtor helping you as well, depending on the situation.
Right. So there is another question about where do you get information? Really, if you want to start by just sending me an email, I can get you headed in the right direction on any of these things. Hopefully you have my contact information from your registration where you signed up for the seminar. If not, I just put it in the chat, but it's basically chrisangel@mountaincu.org. If you want to reach out to me, I may not be able to answer your question, but I can definitely find out that answer for you or get you headed in the right direction. Like I said, get you to the right branch, the right loan officer, the right program, all those things. If you want to start with me, that's probably a good way just to make sure that you get answered in a timely manner. So if you have any other questions, feel free to email those to me. I'm going to stop the recording now so that we can